Hello everyone, how are you? Welcome to today's session, and today's topic is market structure, and we're going to look at the definition of market structure. We'll look at the types of market structure. We'll look at break of structure, shift of structure, and also we'll discuss range. So yeah, let's go to what is market structure. Market structure can be defined, the definition rather. Market structure shows the direction, trend of the forex market, either upward trend, downward trend, or consolidation. Market structure actually shows the directional bias of the market. It shows us the current position of the market. It tells us that it shows us that okay, market is buying or market is selling or market is just consolidating. It's basically give us it helps us to like know and also have a sense of where the market will go. So now we have the different types of market structure. We have the bullish, we have the bearish, and also we have the consolidating, ranging, we have a lot of names for it. So for the bullish market structure, this is the point where markets create a higher low, higher high, higher low, higher high. This shows that market is buying. For the uptrend, it shows that market is actually what? Buying. And while buying, they will be creating higher highs and higher lows. So for this now, we have low. We have a low. The markets move up to create a high. Then markets came down here, gave us higher low, then went up, create a higher high. Then we had higher low, higher high, higher low, higher high. For us to have a valid higher low, markets have to create a higher high, right? And for us to have a valid higher high, market has to close above the previous high. Like for example, this high must be higher than this high. This high must not be lower than this high. It has to be higher than this high to tell us that yes, we are really buying. And markets can't be buying forever. They have to sell at one point. So after buying for a while, market has to sell down, but this sell must not go below the previous low. When market sells below the previous low, it means they are no more interested in this long-term buy. Now they are shifting from buying to selling. That is if this low is lower than this low. But for a valid bullish trend, for a valid uptrend, the higher low, the low must not be lower than this. It must be higher than the previous low. So we have two conditions now. For the highs, the high must be higher than the previous high, and for the low must be higher than the previous low. So the high must not be lower than the previous high, and the low must not be lower than the previous low. This, if you have this kind of trend, it won't be like picture perfect. Markets will do it higher, 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 low, higher, high. But when we have this particular pattern in the market, it shows that we are bullish. It shows that we are bullish and we have a uptrend. We are in an uptrend. So these highs and higher highs, higher lows are actually called swing high, swing low. So markets will create a swing high, sell down to create a swing low, then buy up to create a swing high, sell down to create a swing low, and buy up to create a swing high. So this is a bullish market. This is when market is just, keep going up, 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 up. And yeah, so let's go to the next one, which is bearish market. A bearish market is also known as downtrend. It's also known as downtrend market. And in this particular situation, market price will be creating lower lows to create a low, lower high, lower low, lower high, lower low, lower high, lower low. I actually got all these pictures from Google, so it's not like my own personal pictures. I want you to keep watching this video because in the middle of the video, I have some explanation on the difference between break of structure and shifting structure. So I want you to watch it to the end in order to enjoy the full package, right? Yeah. So now for the bearish market, markets we have like lower low, lower low, lower high, lower low, lower high, lower low, lower high. So market keeps going out down. Now the two conditions that are kind of like applied to this bearish market is that the lower high must not be higher than the previous high, and the lower low must not be higher than the previous low. It has to be lower than the previous low, hence the name lower low, lower high. So here it is low, but it is lower than the previous low. Here it is high, but it is lower than the previous high. You get, so we have lower high, lower low, lower high, lower low, lower high, lower low. It shows that market is selling. It's selling down. It's selling down. They're not really buying. They're buying, but then they sell. The algorithm is selling more than buying. So market is just like selling down, selling down, selling down, selling down, with just little bullish movements. So that is that for bearish market. We have consolidation or consolidating market. So now for the consolidating market, here we don't really have a direction. We don't have a clear direction. We don't have a clear direction if we are buying or we are selling. Market is just moving sideways, like just moving sideways, no direction. So here, as you can see, we had a bearish market before this consolidation phase. We have lower low, lower high, lower low, lower high, lower low, lower high, lower low. Now market is just like moving sideways. They bought and they sold down, bought, sold, bought, sold. Sorry, bought, sold, bought, sold, So they were just like buying and selling. No clear movements. They're not like going up, like all this kind of move that they'll just sell down, no. But they're just like consolidating. So yeah, we don't have a direction. Market is just doing its thing, building up liquidity. So now let's go to the next one, which is break of structure. Now, break of structure is when we are like mitigating, we are still following the trend. Like for example, we have high here, we have low. For a bearish market, markets will go up to create a lower high, then come down to create a lower low, go up to create a lower high, and come down to create a lower low. So this low, when market moves below this low, it's a sign that now we've break this bullish move. We've break this bullish move and we are now expanding. I'm still going to make a video on expansion and retracement and reversal. I'm still going to talk about those ones. Although I will discuss reversal in this video. Well, there will be another video on expansion and retracement. But for now, let's just explain this. Now, break of structure is when we break the retracement. When we break the short-term move in the market. The long-term move is, for a bearish market, the long-term move is us selling down. The short-term move is us buying, right? So when markets break the short-term move, which is the buy, we call that a break of structure, break in structure. Then markets create a lower low. Then we have a lower high. Now we have sell, we bought, then we sold down. So here markets break the lower the short term move, which is the bullish move, which is also the buy move. So markets break it down, shows telling us that now we are not buying again, we are now selling. So that is also a break in structure. So break in structure is continuation of the main trend, the continuation of the main trend. If we are bullish, sorry, I want to admit some people. So if we are bullish, the main trend is creating higher highs, higher highs, higher highs. The short-term trend is just creating higher lows. So for this bearish market structure now, the main move is creating higher and lower lows, lower lows. So when markets create a lower high, we expect them to break the lower low to create another lower low. So that is what we call a break in structure. Now we have, for the bullish market, this is when we have, we have our lower, we have our high, low, then higher high, higher low, higher high, higher low. So as market is breaking our higher highs, it shows that we are buying more. We are buying. We've moved, we've stopped selling, now we are buying. So that is breaking structure. Breaking structure is majorly used as continuation of the main trend. Here we have trend continuation. So it's like continuation of the main trend. Now let's move to shifts in structure. So now let's move to shifts of structure. Here we thought this is, now we are not like continuous, we are not following the main trend now. Now this is when market is about to shift from one particular trend to another trend. For example, here at first we were like bearish. Market was creating lower lows, lower highs, lower lows, lower highs, lower low, lower highs, lower low, lower highs, lower low, showing that we are bearish. Now, we have two conditions. We have two conditions apply to each trend. Here, market, the low have to be below the low and not higher than the low, higher than the previous low. And our lower high must not be above this lower low. It must be lower than this lower high. When it is above this lower high, that means we are no more bearish. And that That was what happened here. Market closed above the previous lower high. This situation here is called shift in structure. That is, market is no more selling. They are now about to start, buying. This is just like the move that will tell you that now we'll stop selling. We are about to buy, right? So market stop selling, they move to the bullish trend, the uptrend. They created higher highs, then higher lows, higher highs, higher lows. When we have this second higher high, this shows that yeah, we are bullish. So we just want to like wait for them to sell down to this area, then buy. So this area here is called shift in structure. Okay. We can also have a situation, I thought I have a diagram on that. We have some situation also that if it's about like creating highs, higher highs, higher lows, higher highs, higher lows, higher highs, higher low, higher high. If market should sell below this lower high, this higher low rather, if market should sell below this lower high, this higher low, this shows that we are no more buying. Now we are about to sell. So markets will close below this low, retrace up to create a lower high, then lower low, lower high, lower low, lower high, lower low. You get this range now it shows us the current position of the market, like what market is currently doing. Now, if you are in a bullish trend, for example, and we have low high, lower, higher low, higher high. This point between this swing lows and swing high shows us the range. This is a range. This is known as range. When we come down, we want to buy or sell within this range. The range gives us the opportunity to identify our entry and our stop loss, and also our target. It helps us to identify a clear entry, a clear stop loss, and a clear take profit. So we have for the bearish market, is a range is the move between the higher low and the higher high. Here now, this is our swing low and the swing high. This is possible swing trade entry. For a bullish market, you want to buy at the low. You want to buy at the discount zone. And for the bearish market, you want to buy at the premium zone. So for this bullish market now, you want to look for your entry within this range. This is the last range. And also, if you want to look for entry and exit, there will still be a video on that though. The last range is what you're going to use for your entry and exit. So this range, identifying the current range, help you to have good setup, like a valid setup. Because, for example, now, if we have this swing high and swing low, you want to look for your sell entry around this area. Stop loss should be above your range, and your target must be either you can identify an imbalance around this discount zone or below this range. So you don't want to come here and set your entry here when this is the range that you're supposed to take. So market should not invalidate this lower high. Like on a normal situation, if they are to like continue the trend, markets must not invalidate, they should not invalidate this lower high. The normal move is for them to just retrace, then keep selling down. The moment market buys above this high, it shows that they are no more selling, they are now buying. So markets will move down, markets will sell down, retrace, sell down. So this swing high and swing low is our range. When markets create a lower low, we are no more looking for entering here. Now we are here. Now we'll move from this range to this range. You identify your swing high and swing low, and you want to take your trades within this swing high and swing low. Are you getting it? So also for the bullish market too, this is the range, the swing high, the swing low, and the swing high. You want to look for a trade within this swing high and the swing low. You don't want to look for your setup outside this range. When we create a higher high, you don't have to come to this place to look for entry. You move with this range, swing low, swing high. Look for possible entry, your exit here, your TP here. Market retrace to that area, then moved up. A normal trend, for a normal trend, markets will not create a higher low below this low. It has to respect this low and just move up. So the moment you create a higher high, this higher low is valid. Then markets can retrace to this area, then move up. So that is how it's going to be. So I hope you understand this. Market structure help us to know the direction, and also when you are able to identify your bearish market, when market is bearish, when market is bullish, and when market is consolidating, this will help you to know when to buy, when to sell, and when to just sit down on your hands and watch the market do its thing. Then when it's give you a clear direction, you join and you take a trade. So with that being said, thank you so much for watching this video to the end. Don't forget to subscribe and like my video, and you can share this video with your friends, family, anyone that have interest in forex. You are free to share this video with them. Thank you. Bye.